Welcome to Barchart's weekly series of webinars designed to help you, the investor trader, better understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you to make a more informed investment decision. Today's session, protecting your portfolio from market downturns. So since the lows of March 2020, you can see that the broader S&P market has been up over 100% from the most recent all-time highs. And even the most cavalier or uninterested long-term investor would be hard-pressed to say that these have been extraordinary gains. But some of the S&P's high flyers have already pulled back some 20%. And this has put a significant loss to those dollar gains. A disciplined investor will have a well-designed plan to protect their profits from these healthy but necessary market corrections that all bull markets go through, but also contingency plans to provide insurance in case of a catastrophic loss. Because the worst thing we can commit as investors or traders is to let big profits turn into losses. Hello, everyone. My name is John Rowland, and I'm Barchart's head of trading education. Today's session, well, I'm going to offer you guys up some simple but timely ideas and strategies that will allow you, the investor or trader, keep these profits, but also, to protect them from these inevitable corrections that all markets have. Now, today's session is for educational purposes only, and all trading has inherent risk. And we're going to be looking at several different types of leveraged markets, including options and futures. And options and futures are not suitable for all investors or traders and can cause greater losses than your original principal. So we at Barchart recommend that you consult a professional financial advisor to determine your financial condition and your ability to bear these types of risk. And under no circumstances shall we be liable for loss for you or anyone else that is incurred as a result of trading or investment activity based on information or material that you're going to receive from Barchart.com or one of our webinars. Okay. So when I was a young, wet behind the ears undergrad student, I had a finance professor who taught an investment class. And now this gentleman was born in 1911 and had lived through 4 major wars of depression, multiple recessions, and we consider him a market fundamentalist. In other words, he believed in valuations, earnings per share, cash flow, dividends, all those kind of elements that stock traders would use, right? And he offered up a piece of advice that has always stuck with me. And that was, if you wouldn't buy a stock you already own, then sell it. Now, it's okay to sell markets when the valuations get too high, when you feel that it's time to lock in some profits, or you're unsure of the market's potential, right? Don't wait for a crash. But I'm a market technician, right? I'm not a fundamentalist. I do look at fundamentals, but I tend to look more at technicals. So I don't want to sell just on emotion or based on some kind of valuation, right? I want to be analytical about my decisions to exit a trade. So that's why I believe in stops. Now, why do we have stops, or why do we use stops, right? Well, stops purpose is to protect us from these losses or these corrections in the market, be it small, in this example here, or catastrophic, right? Now, I hear a lot of excuses from investors and traders, right? Why they don't use stops, okay? I don't trust stops. The market always stops me out and then reverses right away. I'm not concerned with a correction because the market always comes back. Or if I wait long enough, the stock market always goes up. And, there are some truths to these statements in terms of, the market does come back, right? But here's an example of Intel. It took almost 17 years, 18 years for Intel to get back to its 2000 levels, right? And it had to have an extraordinary gain of almost 400% over that 18 years. Bank of America, another great company, great American company, right? From the crash of 2008, right? Yeah, it's come back. It's come back a lot, but it's taken it almost 11 years or more and an extraordinary gain of almost 2,000%. So a well-disciplined investor is always assessing risk and then trying to maximize profits, okay? So let's talk about stops, right? There's a logical progression to stops. Now, we've discussed this in previous risk management webinars. And, for today, I want to concentrate on is after the market has rewarded us, right? And how to determine when it might be prudent to cash in, or at least enact some protective measures to eliminate some further losses and allow us to reassess risk. Right. So just some basics about stops is that all trades start with a stop, right? How can you enter into a trade without knowing your risk, right? That stop loss, right? My risk, right? And my risk or my stop loss will determine my rewards or my targets, right? But as the market moves in our favor, how can I protect my gains? So there are two common types of what we call trailing stops, right? And these are trend lines and moving averages. Now, these are very subjective data points. So what we're going to look at and we're going to discuss is how to improve the outcome. And we're going to use some technical, something called a parallel line stop. And this will move our stop away from clusters of other stop areas that most traders use. And we'll look at this distance from trend lines and moving averages in terms of a percentage of price or maybe points. Or one of the things that I use is one daily average to range. We'll discuss about price violations, right? Specific data points, right? When the market is making new lows, maybe a new weekly low or a new monthly low. But we're also going to ask ourselves, will my stop be static? In other words, I'm just going to set it and forget it. I'm going to just leave it in the market. Or I'm going to wait for an intraday alert and then a close of the day execution. And we need to also determine how much we allow the market to take back, right? How much we would consider to be a correction versus maybe the beginning or could be the beginning of a new downtrend. Is that 5? Is that 10% for a correction? Or greater than 10%, is that the beginning of something more ominous? We could talk about absolute dollar values, right? I'm up $5,000. If I lose or market takes back $1,000, I'm going to exit that trade. I'm going to bank that money, and then I'm going to look to get back into that trade. And then finally, we're going to look at a couple of technical analysis in combination with these previous mentioned static data points. One we're going to talk about is the average true range. We're going to look at a multiple of average true range, and we're going to use this and tie this into significant highs or swing highs that our market is creating. And another one we're going to look at is something called a parabolic time price, sometimes referred to as a stop and reverse. All right, so let me go back to my little chart here. And this is Microsoft, right? And again, I just want to be very clear here. I'm not recommending or saying that Microsoft is going to go down. I just like using this as an example because you can see that Microsoft has made some extraordinary gains since 2015. Matter of fact, it's up 650%, right? That's a significant price appreciation. But we can see that just a small correction back to the previous month's lows would be a correction of about 7% or about $21. And we can see that in the past, Microsoft has had corrections, right? So is 7% a correction value that I'm willing to risk? And below 7%, am I worried that maybe something ominous could be happening? In this case, we could see that, yeah, below 7%, there could be potential for us to be breaking this short-term trend line or this monthly 3-month trend, and that prices could pull back. And we can see that in the past, Microsoft has had some major corrections. It had a 30% correction. Now, imagine if that happened today, right? That would be close to almost $100. And if we think about that in terms of our initial investment, like for many of us who bought Microsoft 5 years ago and sat on it, why it just floated between $40 and $50 and did nothing. Well, $100 pullback in Microsoft compared to my initial investment would be almost a 200 or 250% loss. Very significant. Right? Do I want to allow that to happen? How would your portfolio look if that you allowed that to happen? And could you emotionally handle that loss? So here we can see that 7% correction is not necessarily a signal of a bear market, right? It could be just a signal of a pause or a correction to this bull, right? So how much am I willing to risk in terms of a potential correction, right? Microsoft looks like it's still going higher, right? So what will I allow myself to let the market take back from me before I'm worried about setting some stops or ringing the register? And we can see in this example here, below 7%, again, this could be a violation of our potential trend line. And then what could be the next level of support? Well, it could be a lot lower, maybe not 30% lower, but certainly maybe back down to, around 250 or 240. All right. So here is Ally Financial. Now I picked this stock because this stock is in the S&P. Now this is not, one of these glamour stocks. It's not one that's in the headlines. It's just a run-of-the-mill stock. It's a financial stock. And let me just draw some trend lines here. So first of all, when I draw a trend line, I try to encapsulate, or I try to get as many closing prices that I can possibly find, right? And you can definitely see this has been a nice uptrend. And, if I go back to maybe a smaller time frame, and I drew another trend line where I try to encapsulate as many closes that I can find, right? This would be, a series of two trend lines that would kind of have to respect in terms of this particular market, right? So where do most folks set their stops? A lot of folks will set their stops right just below these trend lines when they get these trend line breaks. And you can see that over, this period of time, many times price penetrated this trend line, this static line, right? And then went back up. And that's that adage that folks say, hey, I don't trust stops because I get stopped out and the market goes back up. But what happens is most folks put their stops in the same spot, and the market knows these spots, where these spots are. So one of the things that we can start doing in terms of trend lines, and also, let me add one more element here, is I have a template already created that has moving averages that I use for stocks: a 200-day, 100-day, 50-day, and a 20-day. Now, again, if we look at this in terms of, a little bit of a bigger picture, you can see that, the 200-day and 100-day haven't really been in play in terms of this uptrend, this recent uptrend. And the 50-day looks like the market has held the 50-day well above it on this whole rally. So 50-day might be more significant to us. So I'm going to get rid of the 100 and 200 so we can just kind of look at that. And then the red line is going to represent the 20-day moving average. All right. So now we have multiple data points where we could argue it says, hey, that maybe my trend has been broken. And many traders will put their stops below these values. Again, if I look at that 20-day moving average, this red line, you can see there are multiple times where price did dip below that 20-day moving average and would have stopped you out if that's where you set your stop. So what did we say in terms of stop, technical trailing stops? We could start looking at percentages of price movement or points, or this concept of one ATR. So I'm going to go in here and in studies, and right there it says average true range, and I'm going to click on that. And your defaults here, you can change this around if you want. Some folks use 14 days, or you can use an EMA. It doesn't really matter. I just kind of make it simple. I have a 9 and a 20 here. And if I look at where is the range of the average true range, how much this stock would move on average on any given day, you can see it's been on during this whole rally. It's been kind of like just floating right around $1.40. It's gone a little bit above, it's gone a little below, and right now it looks like it's right 138. So about $1.40 in price, all right? So over here on the left, I drew a line, and you can find this over here in your tools, right? This is a ray, and I drew this ray, and I made it $1.40 ray. Now, what's kind of cool about this ray is when I draw it, is I can set price in percentages. And now what I can see is what does $1.40 in terms of ATR represent in terms of a percentage of price in terms of this particular stock. So around $50 or $55, $1.40 represents about a 2.5% change in the price of the stock. So how much will I allow price to move in terms of that percentage? This could be one of my evaluations. But what I will do here is I will take this ray and I'll look at those areas where, let me get rid of this 50-day because it's kind of clouding things up right now. Go back to this. Right, here's my little ray right here. There it is. And I'm going to set my stop below these moving averages, below these trend lines, like most other traders would, but I'm going to add a buffer, this parallel line, this buffer of 1 ATR, 2%, 2.5% price movement greater than, or in this case, less than, below my moving averages or my stops, trend lines. And you could see that, you know, I would still be in a lot of these trades. Now, this one would be this would have been close, and I kind of did the numbers on it, and I think you would have still been in this trade, even though it had multiple days lower before it went back up. So this is a cool little technique that you can use in conjunction with your moving averages and your trend lines. Now, one of the other techniques that we said that we can use is an average true range and a multiple compared to a significant swing high or pivot point. So here is another array that I created. Now, I'm going to use a multiple of 3 ATR. Some traders use 4, some traders use 5. Again, what's nice about turning on the percentage is I can see that a 3 ATR movement for this particular stock would represent a 7.5% correction, right? So is 7.5% a change in my trend, or is this just a correction, right? So I think in my book, it would be a correction, right? Anything below this 3 ATR could be a signal that something else is about to happen. So again, if I just move this off of my most recent high, right, that would put me right here. Notice now what has happened is that my 3 ATRs are starting to line up with some of these other data points, right? In other words, 3 ATR movements is below where price has gone below the 20-day moving average, is below one of my 2 trend lines, right? So we can use this price movement from these significant highs or pivot highs, in this case, right, where price went down, paused, and then went down again. And again, if price has broken some of my other technical values, that would be a sign for me to exit the market. Now, the other thing we said we can start thinking about as well is these price violations, new lows, either weekly or monthly. And so the blue line here represents, in this time frame which we're looking at, represents a 4-week low. And notice that from that pivot, where price has now broken 2 trend lines and the 20-day moving average, that 3 ATR movement, that 7% correction now is signaling to me that there is something more significant here, especially if price does break below this 4-week low. So this would be an area where I'd probably more likely to have my stop right about below that significant recent low. So there's a lot of ways we can use these parallel trend lines, and a lot of things what we kind of want to do is we don't want to use one by itself. We want to kind of blend them together to give us the best possibility of staying in the trade, but also to alert us when we might see a change in our trend. Now, there is one other cool tool that we have in our toolbox under studies. I'm going to come in here and type in PAR for parabolic time price. And the way this one works, and I'm going to go to a yearly here. Yeah, there we go. The way this one works is we'll have these dots that are floating below the market and dots above the market. And basically the theory of this analysis is that when price breaks above the dark blue dots, it's telling you the trend is moving higher and that you want to reverse or go long. And if price breaks below the light blue line, then the trend is reversing to the downside and you want to go short. It's an assumption that you're always in the market. And you can see that the light blue line sometimes is very timely and picks these reversals in trends. And sometimes it gets whipsawed, or in other words, price reverses right after breaking the lines. And you can see that recently this blue dots was very timely in terms of where it is compared to our 20-day moving average, right? Our trend line, our movement from our ATR, right? So again, I wouldn't use this as a standalone, but if my parabolic line is lining up with my trend line, which is lining up with my moving average, which is lining up with a weekly low or a monthly low, then these points start to become more significant, right? And that this would be a sign where, in this case, once price broke below maybe this trend line right here, because it's now below a 20-day moving average, and my parabolic time is telling me that there is a potential change in my trend, that would be a signal for me to stop myself out. Okay. Yeah, I think that's what I want to cover on that. All right. So let me ask you guys a question. Well, first of all, actually, let's come back. We'll come back to this. Let's do this. Do you, in your daily or monthly routine, purchase a good or service that you plan on never using, or you hope to never use? And every month or every 6 months, you buy that good or service again. Yeah, we do, don't we? It's called insurance. Car insurance, home insurance, life insurance, fire insurance, flood insurance. Well, as an investor, buying puts offers us insurance to downside price risk. And if we think about these puts that we're going to look at in terms of insurance as a cost of investing and not as a profiting or a profiting opportunity, then they take on a different perspective, right? So what's the definitions of a put, right? So just help those who are new to this. Well, a put gives you the right, not the obligation, to sell a specific amount of an underlying security at a specific price at or by a certain date. What are some of the benefits of a put? Well, for long-term stock investors, right, stockholders who are not considering selling, right, maybe stops are not for you because you don't want to sell for tax implications, right? Or maybe Aunt Melly gave you that stock and there's a sentimental reason why you keep that stock. Or you like that stock because it's giving you a 5 or 6% dividend, right? You don't want to give up that dividend, right? So puts offer price protections over variable time horizons and offer our investors this insurance policy to downside or to offset risk to falling prices in the underlying security with a limited dollar cost. We can fix our costs, and we know that we're not going to risk in terms of a dollar value more than what we do for the price that we pay for those puts. And since all options are wasting assets, put buying protection should be viewed as a cost of long-term investing, not a profit opportunity. So here's the second question. Those of you who are more familiar with options, particularly puts, if I asked you what type of strike put you would buy, at the money, in the money, or out of the money, I'll let you think about that for a second. I believe that most of you would answer out of the money puts because they're cheap, right? And we want to protect ourselves to price action to the downside. Well, the selection of a put will determine how much profit potential we want to give up and how much downside risk protection it will provide. So the purchase of an out of money put will not provide as much downside protection of an in the money or at the money put. But an out of money put will cost very little, and therefore it will not burden us on potential profit if our stock goes up. If I purchase an in the money or an at the money put, it vastly improves my downside risk exposure, limiting my losses. But it will require a much larger upside rise in the stock to offset that cost of that insurance. So the question now becomes, what types of puts am I going to buy, and what ones are going to give me the best benefits? Now, it depends on every trader. It depends on your goals. It depends on what you want to protect. If you just want to protect from the catastrophic, then out of the money puts might be the best answer for you. But if you are looking to protect yourself to market corrections of 10% or more, then maybe looking at the money or in the money puts will give you that greater benefits of protecting you to the downside. They might cost a little bit more, but the reward to risk will be a lot better. So it depends on the trader and the trader's goal. But at a statistical level of probability with options, a slightly out of the money, let's say inside of 5% of at the money, it's going to give you the best ratio between downside risk and the cost to future gains, the cost of the insurance. All right, so here I'm in RLI, and we can see that price has kind of been in a sideways motion for, let's say, the last couple months. And again, all the way to the right, you see I drew a ray between $55 and $47. That's kind of the range. So we're going to think about this in terms of this range when we look at options, $55 to $47. If this stock got below $47, I would be concerned that this stock was going to go much lower. And, now $55 is near-term resistance, and again, based against our all-time high, it's an area where I feel like, hey, there's probably a little bit of a cap here, and that maybe the price will struggle if it gets above there. All right. So I've gone to the Ally options page, and where you find that is under options. And here I'm on the volatility Greeks. And I can find that through here as well. And I've picked the October 15s because I'm not really worried about the September 17s. Those are going to expire on Friday, all right? And let's scroll down and look at some of these puts. All right, so what do we say? $47 out of the money. You can see that a $47 put, theoretical value right now is about 47 cents, right? So that cost to buy the put would be only 47 cents. For one option, that'd be $47. So that's not a lot of risk, right? A lot of dollar risk. And, let's think about this in terms of the stock. Let's say I woke up tomorrow and Ally is trading $47. That $47 put that I would buy today for 47 cents would probably double or maybe even triple in value because of the increase in volatility, the big price movement overnight. And that would give me some protection. But think about current price is now $52.50, and if it went down to $47, that stock would now have fallen 10%. And that $47 put maybe have doubled or tripled in value, a big, large percentage. But 47 cents doubled or tripled is only a gain of another 50 to a dollar, right? And so that would only cover a very small percentage of that $5 of potential price loss in this particular stock. But let's think about this in another terms. Let's say that over the next 30 days, the price of this stock starts to fall, but it grinds lower. It doesn't fall very fast. And now I'm a few days away from expiration, and I'm right around $47. Well, that $47 put that I bought at 47 cents or 50 cents is going to expire worthless. And it has given me no protection, no value. So maybe there might be other puts that might be able to do something for me to help me protect myself. Let's go to the other extreme of our price range, $55. If I buy a $55 put at $3.49, and I wake up tomorrow and Ally's trading $47, well, now that put will be $8 in the market. And in theory, that put will probably be in value close to it. If the market grinds lower to $47 as we get closer to the expiration, again, this $55 put is going to increase in value because it's more and more in the money. Now, if I look at this in terms of a cost, though, right, $3.50, and let's say the stock goes up, well, I need my stock to go up over $3.50 in order to offset the cost of that $55 put. Where the $47 put, I only need the stock to go up 50 cents. So it takes away a lot more of my profit potential to the upside. Well, let's look to this terms and break this $3.50 into a couple of variables here. The intrinsic and the extrinsic. How much is it in the money and how much is it time premium? The $3.50 on a stock that's trading $2.50 right now, right, on a $55 put, that's $2.50 in the money. So I'm really only paying for $1 worth of time premium. And I'm going to get much greater protection to the downside, where I'm paying 40 cents or 50 cents for a $47, right? Twice as much time premium compared to the 55. But I'm getting greater protection to the downside. So what do we say? We said that a slightly out of the money, near at the money, will give us the best value. And let's look at the $50 put. So here we can see the $50 put is going to cost me about $1 and $1.10. Again, how much of that will cost me if my stock goes up? I only have to let that stock or my stock go back up over $1.10 to negate this cost that I'm going to entail from buying this put. But if, let's say, my stock goes down to $47, this $50 put is now $3 in the money. And $1.10 put that I bought that's now $3 in the money is going to give me $1.90. That $1.90 is going to cover about a third or about 2/3 of that $4 or $5 price movement from $52 down to $47. So there's a little bit of a better of a trade-off here in terms of risk to reward versus what I want to protect myself to the downside. Now, if I just want to protect myself to the downside on a catastrophic, then the 47 put is going to give me the best dollar value. But if I want to protect myself for a 10% correction, then I'm going to look at those strikes that are at the money, in the money, and I'm going to do that cost analysis to see how much time premium that I'm going to have to put out and how much will that protect me to the downside. Now let's look at a little bit a greater time value. And then I think this will make a little bit more sense to you. Let's go out to December. Again, the catastrophic versus where I want to protect against maybe a 10% correction in this market. Notice that the $47 put now is worth $1.50. Right? It's almost 3 times what it is in March. Again, more time. But my $55 put, it's only $5.10, right? It's really, there's not a lot more in terms of the ratio of the time value. My $50 put is $2.50. So it might behoove me to buy one of these out of the money, one of these at the money puts that give me a little bit more time and greater downside protection. Now, normally what I do is I will probably buy a shorter term at the money put, and if the market starts to go lower and that put starts to increase in value, As I get to those critical numbers, let's say $47, that's a value where I feel that now the market is going from correction to a downtrend. What I'll do is I'll roll out of the short-term in the money put and roll into a longer term out of the money put to give me that greater time protection. Okay, so let's pretend that we're considering buying some puts for downside protection, right? And we've decided to look at buying puts. But we've only discovered that the cost of these puts, that break-even value, right? If I buy a $47 put and it costs me 50 cents, I really don't start getting benefits until the stock price falls below 46.50. That's kind of our, what do they call that in insurance? I'm having a senior moment here, right? Our deductible, it's kind of thing like our deductible, yeah. So selling the buying these puts could be expensive. Let's say my $47 put is $3, right? Now my downside break even is $44, right? That doesn't really give me a lot of protection. So what I can do is I can sell covered calls to finance the cost of these puts. And many times the cost of these out of the money puts can be offset by selling or collecting the premium of out of money calls and creating what we call a protective collar at little or no cost. So let's talk about covered calls, and let's talk about just again the definition. What is a call? Well, it gives us the right, not the obligation, to purchase a stock at a specific price and by a certain date. A call writer or a call seller, which is what we're going to do, gives that right away to the purchaser. But the seller, us, will receive a premium for that right. So what are some of these benefits that will help us? Well, first of all, a cover call is a limited profit potential. It will cap my profit potential based on where I'm going to sell that call. It's going to be above the current price. But it also helps me, it limits my risk to the downside because the amount of premium that I take in or that credit that I take in will give me protection to the downside by the value of that credit. Now, what we can do is we can start selling covered calls on a consistent basis, even if we don't think the market is going to go lower, right? And maybe we won't sell our whole portfolio. We'll sell a percentage of our portfolio. We'll cover those stocks that have major gains. And this will allow me to collect collateral so that I'll have a war chest that'll allow me to buy these protective downside puts. All right, so let's go back to Ally. And again, I'm in the December contract. And again, let's think about that range of price, $47 to $55. Right? And I want to make sure I'm in the right. Yep. So a $55 call has a theoretical value of $2.25. Now, if I sell this $55 call, in essence, I'm capping my profit potential to $57.25, the strike plus the premium that I'm going to collect. So if Ally goes above $57.25, that is potential profit that I will not be able to capture. But what I can do is if the stock stays below $55, now let's think about this in terms of percentage. Currently, the price of the stock is $52.55. And my strike plus my premium gives me $57.25. Well, that's almost a 10% price increase from current price, right? I'd be happy if I could collect a 10% profit in the next 3 months in any one of my stocks. That's just me. But if I collect $2.25, I could use that capital, that credit, to buy a put that is at the money or out of the money. And if you look down here, you can see that our $50 put that was just slightly out of the money cost $2.45. So my net cost would only be 20 cents. 20 cents of cost that's going to help me protect myself. What would we say our gain was? Another $3 from $50 to $47. That's a good risk reward ratio for me, right? Now, what it does do is it does cap my profit potential, right? That credit that would have given me a value of $57.25 if I just sold the call outright. Now my value is $55, so there'd be a less of a profit potential. But again, you know, between now and expiration, a lot of things can happen, and you can see that we go back to some of the shorter term dated options that are only about a month out, that even if the market was right around $55, you know, even those puts might, that are $5 or $6 out of the money, might still have some small value to them. So I could probably get a little bit of value back out of it, right? And then, you know, I'll just let that call be pulled away from me or signed from me, and then look to get back into the stock on the next dip. All right. So cover calls are a great way to help us to finance our put protection to the downside. Now, remember when we talked about those technical signals, our trend lines, our moving averages, our movements of ATRs? So what if we did this instead? We sell a percentage of our portfolio on a monthly basis. You know, again, my personal trading style, I'll be between a third and a half of all the stocks that I own are always covered. And if price breaks one of those technical numbers, those trend lines or those moving averages, or violates a percentage, 6 or 7 or 8%, then that war chest of credit that I've been capturing on the smaller percentage of my portfolio, I'll use that money to buy those protective puts to the downside. I don't always buy those protective puts on a month-to-month basis. I only buy them when the market tells me that something is up, when one of those technical inflection points has been violated, a new weekly low, a new monthly low, a crossover of a 20-day moving average, right? Now I'm enacting a protective strategy, right, based on price action. All right, so that's a little bit about how we can look at options and how we can use a combination of puts and cover calls. I say a couple questions, so let me see if I can answer these questions before we go on to our next section. So Terrence says, how about selling a put? Well, that's counterintuitive, isn't it, Terrence, right? Selling a put, right? That's giving somebody the right to sell to me, right? We want to protect ourselves to the downside, right? So I think you got the kind of the right idea. What we really want to sell is a call. And I say Margot is asking, the assumption is that options that you own at least 100 shares of said stock. Yes, that is correct. If you are going to sell a call, you will not be able to sell a call unless you have enough of that shares of that call too. But you can buy a put even though you don't have 100 shares, right? You might buy a put that represents 100 shares, but maybe you only have 60 or 70 or 85 shares. You can do that, all right? So David Dickerson asks, can you use stops in options? Yeah, that's a price action. You can use stops in options. It depends on your platform. Some platforms won't allow you to put stops in on options. And again, can be a little tricky there. What I would do is probably use an not a resting stop, but as price, let's say I buy a put and it decreases in 50% of value, that would be a mental stop, right? I say, oh, I'm going to get rid of that put, right? It's not doing me any good anymore, right? So you could use it in that sense. All right. So let's talk about some other aspects of how I can protect my portfolio. So let me go back here and I'm going to jump away from my watch list. And actually, listen, I think I already have a preset. Let me go. Yep, here it is. Okay. So maybe I don't want to do all this mechanical work on each one of these individual stocks, right? I don't want to have to look at, figuring out where's the range of price, what's my trend lines and all that stuff. Maybe I'll just want to do it all in one big swoop. So one of the things we can do is we can look at ETFs, right? The exchange traded funds. And we can buy puts on ETFs based on our portfolio. Now, the key here for you is to make sure that you pick the right ETF that matches the concentration or the consistency of the stocks that you have. If you have a lot of technical stocks, it doesn't make sense to buy the Dow ETF, right? Or if you're heavily weighted in the energies or the healthcare, right, or consumer discretionaries, right, then the NASDAQ doesn't make sense for you, right, the Qs, right? So make sure that you find the right ETF that matches or kind of matches. And that could be a blend. You could have a couple ETFs, and many ETFs are very specific to a category, an industry, or a sector. All right. But there is another ETF that I want to show you that might help you in protecting your portfolio to the downside. So I'm going to go in here where it says ETFs by asset class. And I'm under equities and see where it says leverage here. Now, right now it's checked leveraged 1 times. These are long ETFs. But if I click on the negative, let me get rid of the long here. The negative 1 time, these are what are called inverse ETFs. What these ETFs do is they perform when the broader market goes down. In other words, they go up when the price of our ETFs or our indexes go down. So this is a good way to play the market from the short side without actually shorting or selling your stocks. Now, there are a lot of different ETFs, a lot of different short ETFs, and here these are all one leveraged or one-time ETFs. So, we have the Dow, right? Where's the short S&P? Here it is, SH, short SH, right? So they perform as well to the upside as the stock market performs to the downside. So let's say you have a portfolio of, let's say, a basket of S&P stocks that's worth about $100,000, and you fear that the market is going to fall by 10%, right? So a $100,000 portfolio and the market's going to fall by 10%. Well, you're going to lose about $10,000 based on all the stocks that are in the S&P. So what you could do is you could buy the short ETF, right? And look to capture that 10% as the price goes down. But here's the problem. If I buy one short S&P and the S&P falls by 10% and this goes up by 10%, right? You can see that's right trading around $14, $14.50. Well, a 10% increase would be, around $1.50. That put it around $16. If I only own one ETF, I only make right, or $1.50, right? Or if I buy 100, right, I'm making $150, right? If I needed to protect $10,000 worth of price risk in my larger portfolio, now I got to buy what, 5,000, right? 6,000 of these ETFs. Not very cost effective, right? In terms of how much capital I have to put in to protect myself. Now, there are other ETFs that are higher leverage, 2 times, 3 times leverage, which would eliminate a lot of shares. Maybe now instead of buying 5,000 shares, I only have to buy 1,500. Just a little advice on these more leveraged ones. Kind of stay with the ones that have higher daily volumes. I think at least 1 million shares would be where I would draw a line, maybe 500,000. Try to stay away from these ones that only have a few hundred. The liquidity is just not there. So a leveraged ETF will allow you to cut down on that capital cost. But again, we can use leveraged ETFs options, right? Again, getting more leverage. Just remember that if I think the stock market is going to go down and I'm going to look for a short ETF, I'm not going to buy a put, I'm going to buy a call, right? Because I think that is going to go up, right? So just remember that, right? So there are ways that we can improve our leverage using these inverse ETFs by using options. Okay, all right. One more thing. All right, let's go here. So there is one other element, another derivative that we can look at for protection, downside protection. Now, this is not for everybody. I'm going to say it right out in front. But we can trade something called index futures, right? These are futures contracts that are based on the indexes, the Qs, the S&P, the Dow. Now, the problem with these ones for the uneducated or for the small investor is the cost of entry for these are very, very large. So, for instance, the S&P, the E-mini, the margin, the amount of money that I have to put up to allow me to trade one of these contracts is about $12,000. That's a lot of capital that I have to put up. And right now, the S&P is trading $4,400 or $4,470, and we can see that the value of the contract is $50 times the S&P value. So 4,400 times 50 would be about $220,000. So one E-mini contract represents $220,000. Let's say I had $1 million portfolio. Well, in order to hedge that $1 million portfolio using futures contracts, I'd have to trade up to about 4 or 5 S&P contracts, which means that I have to come up with close to, $50,000 in terms of margin to allow me to maintain those contracts in my position. So this is not for everybody. But what's nice about these futures markets, because of the leverage, these small corrections in our markets will give us big profits. Think about this. If I have one S&P contract and the market makes a small 10% correction, 4,400, so 400 points. 400 points times $50 is $20,000. That would go a long way to buying a lot of put options. The caveat, though, is that if you're wrong and the market doesn't go down and the market goes up, you are exposing yourself to greater risk. You will lose more money, right? Not only will it take away your profit potential, but you could lose a lot more money than you actually wanted to. So E-minis and all these index options are great for a more sophisticated trader. They are a great opportunity to get some good leverage. They're a way to generate profits in shorter price movements, these smaller corrections, and maybe you can use those gains to finance your war chest for those other options or other avenues that you're going to use to protect yourself to the downside. Okay. All right. Ooh, wow. Right at top of the hour. I do see that I've answered most of the questions that have been sent through to me. If you have any questions about anything about what we talked about in the webinar or in how I use the website, reach out to support@barchart.com. If you don't know how to do that, just down here at the bottom, there's a contact button. You can go through there and then you can send us an email and we'll answer those questions. So let's talk about a few takeaways. All right, when in doubt, get out. If you think the market is toppy, you think it's overvalued, right? There's no reason why you can't take profits, especially after your market has made extraordinary gains. But let's use stops to make it mechanical and not emotional, right? Put buying offers insurance to downside price action. Put protection is a necessary cost to investing, and it's not a profiting opportunity. We're going to use a percentage of our portfolio. It doesn't have to be a lot, 1%, 2% of our portfolio, to help us buy that insurance that we buy in every day and all the other things that we do, right? So why not protect your portfolio? Cover calls offers us that opportunity to offset that cost, right? But it also does create that opportunity cost if price moves higher, right? Limiting my profit potential. So there's a trade-off. Inverse ETFs provide a unique asset class that appreciates when the broader market falls, but because of their leverage, 1-to-1, 2-to-1, they are not very cost effective. So again, what we might do on these ones is use their options. And index futures are highly leveraged cash security derivatives that track the broader market indexes. The advantage is they offer experienced investors the opportunity to hedge, protect themselves to downside price movements, right? Greater leverage. But the disadvantage is that it increases their risk, increases their exposure to rising prices, and is not great for every type of investor. Okay, so I want to thank everybody for coming. I hope you enjoyed today's session. I hope that gave you some food for thought. I know that right now there's a lot of talk about the market might be in a correction phase, and so hopefully you can employ some of these ideas. If you like being part of the Barchart community, there is a way to sign up. You can get a basic free membership. It allows you access to a lot of things that I showed you here. But you also can try our premium membership, which gives you a lot of extra features. The other thing I want to mention to you guys is that next week, under my tools sections, free webinars, I did mention in the beginning of the show that there are other webinars that we've done about risk management, how to set stops, how to set price. And so there are in here, you will see developing a trade plan, executing strategies, right? And that this webinar will be part of our library at some point this afternoon. So you will either, those of you who attended, will get an email to get a link to this, or you can come in here and find any of the other webinars that we've done in the past. Next week, I'm going to look at our interactive charts. We're going to take a look at the aspects, the tools, the features that are in our interactive charts. A lot of really cool features that Barchart provides. It allows you to, customize charts, customize templates to help you do a better job of assessing your markets. But I'm also going to give you a bit of a perspective on how I use them and some of the tools that I like to use, and show you how I put them to work. And again, what I always say is I let Barchart do the work for me. So that being said, I want to wish everybody the best of health, stay safe out there, and the good of all trading.